Good morning and welcome to today's webinar from Arum. My name is Mark Buckley and I'll be your host today. This webinar is titled Consumer Duty, What Have We Learned So Far? I'll now hand you across to today's presenter, Steve Coppard. Steve.
Thanks, Mark, and morning, everybody. Thank you for joining today. So a quick intro to myself and Arum. So as Mark said, my name's Steve Coppard. I've worked in debt management for close to 23 years, and I spent most of that time working in government, both HMRC and the Cabinet Office, so I don't get invited to many parties. About 18 months ago, I joined Arum and Just, the Enforcement Market Integrator, as the Group Director of Debt Policy and Strategy. So a bit about Arum. We're celebrating our 25th year this year. We're a specialist professional services and advisory firm, and we exist to help our clients prevent and resolve problem debt. We have a cultivated team of deep experts in all of the fields that you can see on your screen there. And we also provide thought leadership to the industry through blogs, podcasts, speeches, magazine articles, and so on. So in the spirit of tell them what you're going to tell them, we're going to look at the FCA's consumer duty today and just have a quick look at first at how it's played out since it went live on the 31st of July. So we'll do a quick roundup of what the FCA has been up to in this space. And then we're going to look at 4 specific areas. So hopefully these will be a little bit more niche, but significant niches, and maybe not some of the stuff that we're talking about in other circles. So I want to look at how the money and pension service work on negative budgets could impact outcomes and consider things like illegal money lending and insolvency within that. I want to look at how business-to-business debt can interact with consumer duty through micro businesses, and then take a look at what's going on in the literacy and numeracy space. And then finally, sort of bringing all that together, how I think Know Your Customer needs to evolve to really bring us up to code with the duty. So back in May, Sheldon Mills, the FCA's Executive Director for Consumers and Competition, gave a speech in which he said that the consumer duty will provide us with a lens through which we can assess our rules. Now, I guess while we haven't seen much action in the collections and recovery space yet, it's interesting to look at how the duty is being applied elsewhere in financial services to try and get that sense of where it might go. And I think one very public example was when the Bank of England put interest rates up, and mortgage products, the interest rates on mortgage products went up, significantly and almost overnight. Lots of products being withdrawn from the market and then reissued, whereas there was maybe less timely movement in savings rates and maybe didn't go quite as far either. And the FCA responded to this by putting a deadline on when it wanted to see fair value assessments from the lenders, and then latterly after that, it set out a 14-point action plan. Now, look, one of the reasons I found this interesting was because there was a lot of discussion pre-launch about how vague the consumer duty was, that it wasn't specific enough and didn't give enough of a steer. And now we're seeing the FCA use the duty to set out very clearly what its expectations are in this particular case. So it is indeed, as Sheldon said, the lens through which it is assessing its rules. And then just to show that this wasn't a one-off event, we've seen the FCA taking similar action on insurance products. So for us in collections, or even in other sectors that are as yet untouched by the FCA when it comes to the duty, I think this should serve as a heads up. So if we still have sludge and friction in our processes, if we don't have that laser-like focus on delivering good outcomes at every step of the customer journey, then I really think we need to step up our game sooner rather than later. And I don't know that you can fake this stuff well enough either. I think it has to be the cultural evolution that the FCA said it wanted to drive, that customer journeys will need to be viewed through the eyes of focus groups, and our improvements should be co-created or at least user tested with the groups that we intend them to affect. Okay, so look, I guess the reason I wanted to talk about the work that the Money and Pension Service has done on deficit budgets it's because it's challenging, and I'll be honest, I don't have all the answers on this, but I don't think we can afford to ignore it either. I think in terms of delivering good outcomes under the consumer duty, this customer group has the potential to trip us up. And so what I really want to do here is stimulate thinking and start a bit of a broader conversation about it. So MAPS kicked off this work with a call for evidence in August 22, with specific intent to look at how debt advice in particular could support people to achieve better, longer lasting outcomes, and how creditors and advice providers could then work together to deliver those better outcomes based on a shared understanding of the customer's needs. So some of the findings of the call for evidence were that people often present to debt advice in a state of hardship, and they actually have pressing needs that the advisors need to address before they can get on with the job of providing debt advice, such as food bank and fuel vouchers, so that the person can go home to a warm house and put dinner on the table that evening. Also, the wider issues need tackling if the debt advice is to be effective and actually achieve a resolution. So that could mean needing to bring in specialist signposting, for example. And it found that people with vulnerabilities are particularly likely to have challenges engaging with the process, especially as advice recommendations often require people to undertake complex actions themselves, which they therefore often need help with. And that is particularly true around some of the more complex elements of income maximisation. Of course, all of this takes time, and these cases are likely to remain open with the debt advisor for longer than usual, especially where resolution requires, let's just say, collaboration and communication with government departments. So, for example, where a benefit decision is being appealed. Even insolvency isn't easy in these cases, and in part because of the prohibitive costs to the individual of declaring bankruptcy themselves, and in some of the smaller cases, the lack of benefit to the creditor in actually making the person bankrupt. So from the creditor then, I guess the advisors will be looking for support and forbearance in the knowledge that continuing the collections process during this period may actually drive the customer underground, which will extend the problem for even longer. Now, look, MAPS itself, it estimates that the impact of debt advice on creditors has a net benefit of 135 to 237 million pounds a year. And look, I appreciate that range alone, the breadth of that range shows that this isn't an exact science. But I think it's fair to say that there is a significant net benefit, if for no other reason than the reduction in ineffective debt management interventions. So while figures on the extent of this, so how big is this issue, are sketchy, Citizens Advice estimates that it's affecting 1 in 10 people. So just as a rough calc, with what, 41 million working age adults in England, we're looking at 4 million people affected. And even if you wanted to challenge that volume, and let's be generous and reduce it by half, it's still 2 million people. Now, look, that's twice the number that is estimated are affected by loan sharks, and 8 times the number who have problem gambling debt. And on that point, I saw earlier this week, and with sort of my thanks to Jason Wassell, the chief exec of the Consumer Credit Trade Association, for banging the drum on this, which is how I noticed it. The FCA is at the moment consulting on its product sales data collection, including where decisions not to lend have been made. And if this goes ahead as planned, it will, really move the data requirements from aggregated product data to agreement level data. And if anyone wants to know more about that particular thing, please contact me and I can share the link with you. But getting back to the issue of good outcomes, there's currently a couple of opposing views on the market. That regulation of, I guess, what we would traditionally refer to as subprime lending has, on the one hand, led to a reduction in unaffordable debt, which is great and to be applauded. Yet on the other hand, it's left people without lines of traditional credit when they need it. stoking fears that it could push people into the hands of illegal money lenders or even towards premature insolvency. So from our perspective, I think that's important that we push the message that other forms of lending, such as credit unions and no interest loan scheme, the Fair for All finances administering are available. And I'm kind of digressing here, but I guess where I was getting to on this is that resolving debt for people with negative budgets requires patience on the part of the creditor and a lot more time and effort on the part of the advisor. And in these particular instances, it seems to me that the best chance you've got of getting paid is to give the advisors the time and the space that they need to get the person back on their feet. So, for example, if the advisor can find additional benefits that the person is entitled to, that could bring them back into a positive budget situation going forwards, while at the same time the back payment of the benefit could actually clear some, if not all, of the debt. So look, we don't yet know how the FCA will view this, even if it will delve into this level of detail. But the reason I mentioned the data collection is it certainly seems to be going into detail in other areas at the moment. And as we frequently find, doing the right thing for the business is quite often the same thing as doing the right thing for the customer. We know that people in a negative budget situation won't fit into the average personas that we create to illustrate customer journeys. But at the same time, we also know that those personas will never capture every eventuality anyway. So I guess we should be looking to adopt the Pareto principle and understand that we'll ever only capture 80% of the population through those standard personas. And that isn't to say the creditors aren't set up for this. I know many firms, have teams set up to deal with vulnerable customers. But I just wanted to highlight that, with Consumer Duty, the lens will fall on it at some point. And I think this segment in particular will need a different approach. Okay, so looking at business to business then, and I just wanted to touch briefly on this, the potential for business debt to come into the regulated space through micro businesses mainly. So I did a podcast with Andy Hignett, the credit controller of Johnson Tiles, and we met through a Chartered Institute of Credit Management event that he hosted, and it opened up for me a whole other world of debt that's sitting there, but often unseen by many of us in the day-to-day. So Andy and I are both interested in the psychology of debt, and we were looking at how attitudes of personal debt sometimes transfer across into the business-to-business debt world. Now, look, Johnson's is a traditional manufacturing business. It's over 100 years old. And Andy himself looks at the credit records of every business that they go into a relationship with and decides what credit terms each business will be granted, if any. It's a manual process based on the available data and the experience of the credit controller. So it's a far cry from the standardized automated affordability assessments that financial services will employ to decide, for example, whether a credit card will be issued or not. And when you extrapolate sort of that Johnson's example across the industry, you can see how there could be a fair amount of variability in decision making based, like I said, on the experience of the individual credit controller. And Andy was telling me, that in recent years his customer base has shifted, and it's no longer comprised almost exclusively of large business clients, but there are more and more micro businesses buying from them. And what he's seeing is the lines of credit that Johnson's issues to people will use that available credit and then want to extend repayment terms before finally paying down their accounts using a credit card, which on more than one occasion has been a personal card rather than a business card. So you potentially have an unregulated credit product entering the regulated credit card customer journey, I guess much in the same way as Buy Now, Pay Later did at the start. And of course, this is a situation where the business creditor is more likely to look at litigation if they think there's a chance that they could get repaid, which I guess presents a bit of a risk to those of us working in the regulated sector in terms of how we then manage that customer. So look, I don't want to dive into this any deeper. It starts to become a very thorny issue as to when business exemption under Consumer Credit Act comes into play. Even the gov.uk site talks about the types of business activities that require FCA authorization. And it says you don't need to be authorized if you're only offering credit to another business. But it goes on to say that if you offer credit to sole traders or partnerships with fewer than 4 partners or unincorporated associations, then you probably need to be authorized. So clear as mud. Anyway, okay. So just wanted to touch on that one briefly. So let's move on to numeracy, and I'll touch a little bit on literacy in this as well. So numeracy or financial literacy is a named vulnerability that the FCA identified through its Financial Lives Survey as being an area where firms should check to ensure that customers really do understand the product or service that's being offered to them. So Plain Numbers is a not-for-profit that operates in this space, and it found that if you give somebody a document, including numbers, and set out in a traditional format and ask them if they understood it, then they're likely to say yes. But if you probe them a bit more and get them to try and explain the concepts, then they struggle. And it's likely to be because the words and numbers in and of themselves as individual items on the page are intelligible, but the concept or fact they're communicating isn't. So that in tests that Plain Numbers did, it found that 70% of people say that they understand a document, but when actually probed on it, the actual number was less than 30% really understood the concept. So look, there's a couple of real quotes on the screen there. So first from a mortgage customer who pretended to understand because buying a house was their financial goal. And yet when that became a reality, it was a struggle to afford the repayments. And another in which the customer needed help with their debt, but didn't know what their annual income was. And so ended the call there and then didn't seek help again until they were in debt for more than 30 grand. So Ben Perkins, the Director of Partnerships and Services at Plain Numbers, discussed this case with me again in a recent podcast, along with a more in-depth look at some of the issues and potential solutions. And I think some of the language used here tells a story too. So I was totally baffled. I had no hope of understanding. Numbers terrify me. I was so embarrassed. Now, look, some of you may know that I'm fond of saying that debt resolution isn't about numbers. It's about people and behaviours and circumstances. And I think what we see here in these examples are very human reactions to numbers. So Plain Numbers' own research says that 49% of adults have numeracy levels at or below expected the levels of an expected primary school leaver. And then the FCA's Financial Lives Survey found that 34% have poor or low levels of numeracy involving financial concepts. And here's the critical bit, that it expects firms to take these characteristics into account in communications to customers. So Plain Numbers reckons that its approach can double comprehension rates. And look, its growing list of corporate logos suggests that a number of firms do actually see the benefit in this. So they've got clients encompassing high street banks, top insurance brokers, utilities, healthcare providers, even the Financial Services Compensation Scheme. And I wanted to leave you with a thought about the power of the Financial Lives Survey, which isn't my thought. I found this late last night when I was just skipping through before bed, but I wholeheartedly agree with it. So I need to give credit to Andrew Gething, the managing director of Morgan Ash, for this thought. So Andrew was quoted by the IFA magazine yesterday as saying, "If you don't benchmark, there's no way to find out how you compare against others, how you can improve performance, spot inefficiencies, or determine the best course of action when changing or updating processes. The benefits of using benchmarking to manage consumer vulnerability and compare against best practice cannot be emphasized enough." And Andrew went on to say, of course, consumer duty is new, so there are few battle-tested benchmarks, and most companies won't have annual or comparable data to compare with their peers. but there is a decent place to start. The FCA's Financial Lives Survey has provided some good data. And look, as I'm quoting Andrew last minute without having had a chance to ask him, I think it's only fair that I give a nod to Morgan Ash's resilience system, also known as MARS, which through a benchmarking exercise, they were able to show similarities in the number of vulnerable people across their clients by a given set of criteria, a comparable number to the numbers, the data produced by the Financial Lives Survey. So I think the Financial Lives Survey, if we're lacking data and want something to benchmark against, Andrew's idea there of benchmarking against the FCA's Financial Lives Survey is a great way to get a source of intel that we wouldn't otherwise have. So where all of this points to, for me, is kind of know your customer 2.0. We know that the FCA is proactively using the duty to hone in on issues. I guess what I'm highlighting today is that there are a number of significant niches in Know Your Customer that we can probe to enhance our understanding, be that in the most extreme forms of ongoing financial hardship, or those who are using regulated credit products to pay for unregulated lines of credit, or how we can improve outcomes for people who just don't get numbers in the way that we tend to explain them. And on that point, I think it's worth telling the story of Holly Warner, who works for what I would call literacy supremos, a company called Amplified Global, who are doing some fantastic work in the FCA sandbox at the moment. So Holly went on stage after Sheldon Mills at the FCA in East London and gave a talk on audience design, which is a socio-linguistic theory from the 90s. Stick with me on this one. It says that firms first write letters to satisfy the legislation, and then they write them to satisfy, if they've got one, the regulator, and then they write them to satisfy the firm's legal team, and then to satisfy the marketing and branding team, and then to satisfy the author's line manager, and then finally, right at the very end of the process, is the customer considered, by which time, as the fifth or sixth person in the chain, there isn't much room for manoeuvre. All right, so look, just before we wrap up, I wanted to give just one more example of this. And this one's around really understanding diverse ethnic communities and the challenges that they face, which are complex to say the least. So I interviewed Muna Yassin, MBE, the chief exec of Rooted Finance, and she explained something called the ethnicity premium to me. So one of the examples she gave was that all other things being equal, from what we can see, Black people pay on average £250 a year more for car insurance. Now, there isn't a suggestion that simply being Black leads to that disparity, but the problem is we don't have the data to explain it. And there are very similar challenges faced by debt advisors working in this space. So, for example, where we have migrant communities working in the UK to send money to their families back home, there's nowhere on the standard financial statement to record that information. And so it ends up getting hidden in other pots by well-meaning advisors. But what it actually does is it masks the fact that this is a common feature that lenders aren't being made aware of, that collectors aren't being made aware of. And so we don't have, for example, trigger figures for these amounts. It's down to what the individual advisor thinks is fair, again, using their individual experience. And that theme goes back to what I was talking about with Johnson Tiles as well. I think we need to be driving out decisions based on individual experience and try and use data wherever possible. So look, we're about there, folks. I just wanted to say we've got on each of the topics that we've spoken about today, we've got a more in-depth podcast. So please do feel free to go along and check that out, or get in touch with me on the number on the screen there. And with that, I'll say thank you very much for joining this webinar, and I'll hand back over to Mark.
Thank you, Steve. Just see if any questions have come through, or if anyone who's been listening wants to submit any questions, please do so. We've got a couple of minutes still remaining. We'll give people a few seconds to do that, Steve. But if nothing comes through today and you do think of any questions that you want to ask, you've got, or you had, Steve's details there, although I'm certain we can get them to you if you haven't written them down. Oh, there we go, Steve. There we go. So there's nothing come in quite as yet. So we'll just give it a couple more seconds, Steve, and then we'll probably wrap it up if nothing comes in. Okay, obviously everyone's shy today, don't want to ask questions.
I'm sure that's not really the case, Mark.
No, true. Okay, we'll end it there. So I'd like to thank you, Steve, very much for your time. Thank you very much. I'd like to remind everyone who's been listening today that this webinar will be listed on our website from tomorrow, if you'd like to listen again or recommend it to any colleagues who couldn't make it today. Also, before you go, we'd appreciate it if you could just take a few seconds just to give a little bit of feedback in the relevant areas provided. Or someone has mentioned that it was a brilliant presentation, Steve, and thank you for it. So that's really good. And it was a brilliant presentation. And on that positive note, I'd like to thank everyone for your time today, and goodbye. Thank you very much. Cheers.
Thanks, everyone. Bye-bye.